The American stock market is hitting record highs again. Headlines celebrate it, investors cheer it, and on the surface, everything looks strong. But behind these numbers lies a story that most people never hear. A story driven not just by economic growth, but by deeper forces shaping the market in ways that aren't immediately visible. To understand what's really happening, we need to go beyond the headlines. Because record highs don't always mean a healthy market. Sometimes they signal something much more complex and potentially risky. One of the biggest drivers behind these highs is liquidity. Over the past few years, massive amounts of money have been injected into the financial system. Central banks, especially the Federal Reserve, played a key role in keeping markets stable during times of uncertainty. Low interest rates made borrowing cheaper and pushed investors toward stocks. When bonds and savings accounts offer little return, equities become the most attractive option. This shift alone has helped push stock prices higher. But there's another layer to this story: corporate behavior. Many companies have been aggressively buying back their own shares. This reduces the number of shares available in the market, increasing earnings per share and often boosting stock prices. At the same time, technology giants have become an even bigger force. A handful of companies now make up a large portion of the market's gains. Their dominance creates the illusion that the entire market is booming, even if many smaller companies are struggling. Retail investors have also played a surprising role. With the rise of easy-to-use trading apps, millions of new participants entered the market. Their collective activity has added momentum, especially in trending stocks and sectors. However, this kind of participation can sometimes be driven more by emotion than fundamentals. Fear of missing out, also known as FOMO, pushes investors to buy into rising markets, often without fully understanding the risks. Another hidden factor is inflation. While rising prices are often seen as negative, they can actually push stock markets higher in the short term. Companies raise prices, revenues increase, and stock valuations expand. But this creates a delicate balance. If inflation rises too much, central banks may increase interest rates, and higher rates can quickly change the direction of the market by making borrowing more expensive and reducing liquidity. There's also the global perspective to consider. International investors continue to view the U.S. market as one of the safest places to invest. This steady inflow of foreign capital adds additional support to stock prices. Yet, beneath the surface, warning signs are starting to appear. Market valuations are stretched compared to historical averages. This doesn't guarantee a crash, but it does suggest that future returns may not be as strong. Volatility is another factor that many investors underestimate. Markets don't move in a straight line forever. Even in strong uptrends, corrections are normal and sometimes necessary. So what does all of this mean for investors? It means that record highs should not be seen as a signal to blindly jump in. Instead, they should be a reminder to look deeper, stay informed, and manage risk carefully. Because the untold story behind America's stock market highs isn't just about growth. It's about liquidity, behavior, global influence, and hidden risks. And those who understand this story are the ones best prepared for whatever comes next.